Hi, Lori.
How are you, Abraham?
I'm doing very well. Very well. Thanks for joining me today. And so, just to give you all a little backstory, Lori and I met in a Facebook group. I was looking for more information about reverse mortgages. I actually have a client that was interested in using a reverse mortgage, and I knew so little about it that I went to one of the professional pages on Facebook, and Lori was the name that kept on popping up as the go-to person in this area. So I want to bring Lori on the show. We've already had a call before this conversation, but I didn't think that that was justice because I was just learning about it. So now I've had time to research. Lori has kind of brought me up to speed on some things, and I knew that there were so many nuggets to share with an audience that I wanted to bring her back on the show. So welcome again, Lori. Um, Lori, tell us this. How did you get into what were you doing before the reverse mortgage industry?
Well, it's a very improbable story. So I actually started off as a chemistry teacher many years ago.
Okay.
And as I like to say, I got to the point where I couldn't stand my kids' parents.
Oh,
so,
yes.
so I transitioned out of teaching and actually became a writer for a law firm. I was working for a law firm. And then one day got a call from somebody who said, "Hey, we've been given your name. We'd like you to come in and interview for a position as a reverse mortgage specialist."
Mm,
And if you can imagine all of the bad things, the worst things you could say, I chose the worst of the worst and I said, "Reverse mortgages? Are those things legal?" Which just kind of demonstrates that I had a terrible negative bias toward reverse mortgages, even though I truly knew nothing about them. Just in part, it was the very name, I think, reverse. And I like to say, unless you're talking about reversing the aging process or something, just the name reverse sounds creepy. So anyway, as I say, I was in a law firm, and so I got right into the congressional record and read the history of reverse mortgages, and I was there until I don't even know, all hours that night, 11:30, 12 maybe. And when I had finished reading hundreds of documents, I had a complete change of heart toward the program and realized how much of a difference a reverse mortgage would have made in the life of my own grandmother had they been around back then,
mm,
because she wanted nothing more than to stay in her own home. But this was back in the late 70s when the kind of the go-to position was you would move grandma out of her house and move her into the house with the daughter. So that's what we did with my
gotcha.
grandmother, and she just was desperately unhappy. So I did call the headhunter back, and I said, I think I would like to come in and talk about what it would what would be involved with getting into reverse mortgage lending.
Right.
And that's my very improbable story. There are very few people who actually got into reverse mortgages through reading the congressional record,
Interesting.
which is
That's
not known
interesting.
for being gripping reading.
Now let me ask you this before we go into the content. What were you doing at the law firm? You were writing for them. Were you doing like paralegal services
I
or?
was doing paralegal services, but also the law firm was writing some books on international adoption at the time, and I had a background in editing, and so I'd done a lot of technical editing as a completely different side and apart from teaching. So I was
Gotcha.
doing the editing for the books they were writing on adoption.
Nice, nice. That's an interesting story there. Okay, so now let's talk about the reverse mortgages. What is a reverse mortgage?
I love this question, and I'm going to answer it in kind of a well, duh, and then flesh that out. So, a reverse mortgage is a mortgage.
Hmm.
A reverse mortgage is a mortgage. And the reason I start with that is because that kind of surprises some people. What is a mortgage? Well, a mortgage is using the lender's money to help you buy a house or to help you refinance a home you're already in. So it's a mortgage. It's a mortgage just like any other mortgage, with the difference being the direction of repayment. So what I have right now is technically called a forward mortgage because every month I pay it forward. So for the rest of my natural life, I'll be paying a mortgage in a forward direction. A reverse mortgage is a mortgage, but it's not repaid on a monthly basis. It's repaid on the back end in reverse. And that's where the very name itself comes from. It's the direction of repayment. The reason this is such a big deal is because a monthly mortgage payment in the retirement years can be devastating to cash flow, especially if there are other factors, such as health issues where you need every penny that you are bringing in for monthly expenses, or people who are trying to save enough during the early part of retirement with anticipation that they're going to need that monthly cash flow later.
Right.
In retirement.
I guess one thing I notice in my research is when I do come across content that speaks negatively about the reverse mortgage program, on one hand, the individuals will say something about how it's maybe not a wise investment, but on the other hand, they don't really mention about the individual's cash flow position. And so one thing I got from you in our conversation was that this is more of a strategy. This isn't like a use case for everyone, but if cash flow is an issue, then this may be a solution.
So that is indeed the traditional application. Somebody's already having financial issues, they are having cash flow issues, they do a reverse mortgage. Less and less, or I'm seeing fewer and fewer of those situations where somebody is already in dire straits. Financial planners have really gotten on board with a reverse mortgage. They have the homeowner set it up ahead of time in order to prevent cash flow issues down the line. I break them up into two categories: a rescue reverse, and that would be somebody who is having cash flow issues, and we have to get the reverse refinance done very quickly because they're going to run out of money in another 60 days. That would be a rescue reverse. A reserve reverse, and that's actually a real term, a reserve reverse is somebody who's setting up a reverse mortgage in advance, well in advance of needing it, so that when the time comes, they do need an extra pot of money to draw from. That reverse mortgage is just sitting there waiting in the wings.
Gotcha.
And now I do want to backtrack a little bit. You had touched on this a minute ago, but there are two umbrellas of reverse mortgage. One is refinancing the home you're already in. That's a reverse refinance. But then the other umbrella, and I know you're going to touch on this more later, the other umbrella is buying a home with a reverse mortgage. So let's say you're in a house that's just too big, or the layout isn't right, or you're in Florida and you want to be in Maryland next to your, or relatively proximate to your adult children. You have the option of buying your home with a reverse mortgage.
Right.
And not having a monthly mortgage payment on that. So I just want to make clear from the outset that two different umbrellas, just like with any other mortgage, you can either refinance a home you're in or buy a completely different home.
Gotcha. Yes, no, we're going to talk more about that reverse for purchase, because that's actually what my client reached out to me about, was the reverse of purchase. And I was like, I don't think that that's a thing, but I didn't, I figured that she heard it somewhere. So I'm going to reach out and find out some more information about it. Talk to me about the age range for the reverse mortgage product. Like when can you become eligible for that product?
So we're going to limit this conversation for now just to the FHA product. And with the FHA reverse mortgage, which does represent most reverse mortgages, the FHA reverse mortgage, you have to be a minimum of age 62. At least one homeowner has to be 62. The other one actually can be younger than 62. But just keep as a rule of thumb in mind, 62 is the magic age, and then there's no upper age limit. So I've had actually many people over the years who are in their late 90s or early hundreds do reverse mortgages.
Gotcha. Now, how long have you been in the industry?
I got in the very end of 2000, and it's funny, I just looked this up and I can't remember. I think since 2007, the very end of 2007.
Okay.
I think my license dates to 2008, but 2007 is when I transitioned.
Gotcha. So almost 12 years now.
Yes. Yep.
That's amazing. Okay, so you just mentioned something, and this is new to me. So there are actually two products. There's an FHA product, and there is what's the other option?
The other option, I call it the jumbo reverse mortgage. That's not really the technical name for it. It's just called the proprietary.
Okay.
These have some really great advantages, including if you're living in an upper value property So let's say you're in a $2.5 million property.
Mm-hmm.
The FHA lending limit, I'm going to round it down a little bit, but the FHA lending limit is $822,000. I can't give somebody $822,000. That means I can give them a percentage of $822,000 for the FHA. For the jumbo, the limit I can lend against is $20 million. So if you have an upper value home, like you might see in areas of Maryland, certainly areas of DC, parts of Virginia, you have these very high valued homes, and somebody, let's say they need $800,000 for one purpose or another. Then we would look at the so-called jumbo reverse mortgage. Now in Maryland, these are not yet legal. Maryland actually has on their legislative books that any reverse mortgage has to be the FHA reverse mortgage.
Okay.
It has to resemble the FHA reverse mortgage. There is legislation afoot, however, to change that in Maryland. So we'll see.
Gotcha. So it sounds like you can use this jumbo product in Virginia, Northern Virginia, and DC.
Exactly. Yes.
Okay.
Yes. And in many states. Yes.
Okay. Now, when we spoke, you talked about how the different age ranges have the percentage that they're available. I guess that they're either available to qualify for, or well, talk to me about like how the program changes or adjusts as the age increases.
Great question. So with a loan that we all have grown up with, so we'll say a 30-year mortgage, we would talk about loan to value. How much can you borrow as a percentage of what the house is worth, loan to value. So in reverse lending, we don't really talk about loan to value, but we talk about how much do you qualify for. And I'm actually going to scoot my funny jar here over. Let's see if I can do this. So if you think of the house as this, great big vessel, great big, I call it the pickle jar.
Right.
The amount of equity in the home you qualify for is based upon the age of the youngest homeowner. So if somebody's right at age 62, they're going to qualify for half of the equity in their home. The older they get, the more equity they qualify for. So if somebody originates the reverse mortgage at age 80, they're going to qualify for more of the pennies in the pickle jar or more of the equity in the home. And I like to say, I actually had a homeowner use this term, but he said, well, I qualify for more because I'm closer to the end of the runway, which I thought was a very sweet way of saying that. But that's exactly true when it comes right down to it. It's based on actuarial tables. And the older you are at the time of origination, the bigger is your line of credit.
Right. Okay. So why would somebody do a reverse mortgage refinance over a traditional line of credit?
Wonderful question. And I want to preface this by saying there is no right and wrong. There is no one size fits all.
Okay.
Somebody may opt for a forward line of credit as opposed to a reverse mortgage line of credit. And if we were doing a traditional flow chart, so you have the one little shoebox and then you have the two branches coming out of it, the very first branch would be, do I want a monthly mortgage payment? Or do I not want a monthly mortgage payment? And again, there is no right and wrong. There could be reasons somebody would want a monthly mortgage payment. Tax purposes come to mind. But if you decide, look, I don't want a monthly mortgage payment as I head toward retirement, or I don't want a monthly mortgage payment as I'm already in retirement, then at that point, the only option available to you is the reverse mortgage. It's a mortgage, but it does not have a monthly mortgage payment. I'm repeating myself, it's repaid. The mortgage is always repaid, but it's repaid once you no longer need the home, either because you've sold the home or you've passed away. So if there were some reason that you needed or wanted a monthly mortgage payment, go with a traditional home equity line of credit. Okay. If you want a home equity line of credit that does not have a monthly mortgage payment, then you're looking at a reverse mortgage.
Gotcha. Now, talk to me about the interest rates on the reverse mortgage product.
So just like with any other mortgage, you can go with a fixed rate or you can go with an adjustable rate on a home equity line of credit, a reverse mortgage home equity line of credit. The fixed rate, in my opinion, and in the eyes of many experts in the field, has some drawbacks to it.
Okay.
The biggest one being the following. So let's say you go with a home equity line of credit, and it's the adjustable, which means it's attached to the Treasury, to the U.S. Treasury. And let's say you draw it down. You need $50,000 for something or other. I don't know what, but let's say you're paying off healthcare bills or credit card bills or something. You can, with the adjustable, pay the interest back. So if you wanted to make a monthly interest payment, or if you wanted to make an interest payment once a year and then use that as a mortgage interest deduction on your taxes, you can do that with the adjustable. Or if, great Uncle Fred dies and leaves you money, you can put money back into the pickle jar and pay down that reverse mortgage. And then you can take it back out again. If you inherit again, if you have money coming in, you can actually take money out, put it back in. With the fixed rate, that is not available. It comes out in a lump sum. And when you pay it back, it goes back in a lump sum. You can't take it out and put it back in. So I've had many, many, many clients over the years who have opted to pay the mortgage interest, because that does two things. It maximizes the amount that's in your line of credit, so you can pull it back out again, and you can use it for a mortgage interest deduction. So the fixed rate, also they do a funny thing with the fixed rate. So let's say based on your age, you could access 50% of the equity in your home.
Right.
With the fixed rate, they don't give you all of that. They say, okay, you can have 60% of what you qualified for, and the rest has to stay in the house. With the adjustable, whatever you qualify for, you actually qualify for. So you can have all of that in your line of credit. So, so the fixed rate, somebody might opt for that simply because our mindset tends to be fixed rate is always better. But if you look at the nuances of it, for many people, the adjustable rate actually is a far better fit.
Gotcha.
Very insightful question.
So tell me this, with the, you just said qualify for, is it not just that to qualify for the reverse mortgage, it's just not based on your age? Are there other criteria involved in qualifying?
There is. So we have to have equity enough to make the loan work. So for instance, if somebody owes, they still have a huge forward mortgage on their property, we have to be able to pay off their existing mortgage with how much they qualify for. So let's say somebody has a $600,000 home.
Right.
We're going to arbitrarily make this person 65. So at 65, they're going to qualify for about half of it. But if they already have a huge mortgage with, ABC Bank,
right,
and they don't have enough equity to be able to pay off that existing mortgage. So that would be a person who would either have to bring cash at the time of closing. They can take, so in this case, I said the houses were $600,000.
Right.
The person I made 65 years old, they're going to qualify for about $300,000. But they didn't owe just $300,000 on their home. They owed, what did I say, $500,000?
Right.
Well, if we take $300,000 and send it to their current lender, the current lender says, well, where's my other $200,000 you still owe me? So we can't make those numbers work unless the homeowner says, well, here, I'll pitch in that other $200,000. I'll take the $300,000 available through the reverse mortgage. I'll pay the lender the other $200,000. That is allowable, right. But it doesn't happen too frequently. Now, if somebody has a $310,000 mortgage, they may well opt to bring $10,000 to closing. In that case, that might make a lot of sense. But so you have to have at least 50% equity in most cases to make a reverse mortgage work. And then you have to have income enough to pay your property taxes and your homeowner's insurance. So you can't, after you have a reverse mortgage, once you have a reverse mortgage, you still have to pay your property taxes and homeowner's insurance.
Gotcha.
And then keep the home maintained to, what are called FHA minimum standards, which just means don't let a tree fall on your house and not fix it.
Right. And I think I saw one other thing is that the house has to be your primary residence, right? So you have to live in it for 6 months and 1 day. Yes,
exactly. This is a primary occupancy loan only. And so you can't move out and use it for an Airbnb or rent it to your kids or something. Yes.
Now, let me ask you this: with this product, do you so I guess how do I say this? It sounds like you kind of have to plan to use this product. Or I guess the ideal scenario is to plan to use this product, because if you're going to have a high equity position, then you probably don't want to be, unless you have a lot of cash on hand, to be going like to be purchasing a property with maybe 20% down and then saying, okay, great, I'm about to do a reverse mortgage. That you don't have the equity position.
Right, unless you want to stroke a check to
Right.
cover. Yes, yes, yes. So what a great question. Great question. My my dream client is the client who is working with an attorney or a financial advisor
Mm-hmm.
or an adult family member and the adult child, and they're using this strategically. And,
Gotcha.
you know, these have been around for years. I think 87 or 88 is when they were signed into law and brought under the FHA umbrella. And so wealth managers, financial advisors are very much apprised of this at this point. And when they see this as part of a long range financial planning tool, oh, these people fare so much better than somebody who has completely run out of money and is like, well, I guess I'm going to have to do a reverse mortgage.
Right.
If you see this, you know, so for many of my clients, they have an annuity, they have their Social Security, they have a 401k, they have an IRA. But if that person lives to be 95 years old, all of those may very well be depleted. So if they'll also set up a reverse mortgage line of credit long before they need it, whatever's in that line of credit is actually growing a little bit month over month. It's getting bigger and bigger, regardless of what happens to the home value. The line of credit is growing. So by the time that person who has planned ahead needs to access those funds, there will actually be more funds in that line of credit than there were when they started. And no other line of credit does that. No forward line of credit grows over time in the homeowner's favor. But that line of credit with a reverse mortgage line of credit is actually growing.
Gotcha.
And so it does, and it can also serve as a hedge against, you know, if the home value goes down, it's okay. That line of credit keeps on growing. So it
That's
can be a hedge against fluctuations in the housing market. It can be a
right.
hedge against fluctuations in the stock market where your investments may go up and down over time. But
Right.
this just keeps on a plugging.
Excellent. Yeah, I think one thing I noticed in my research is that there is mortgage insurance on the
Hmm.
reverse mortgage product, but if you're maybe in a market that may be depressed, or maybe the prices just are stagnant, then the reverse mortgage product is almost like a hedge against
Eggs.
that process, because some people, being a real estate agent, some people think, okay, great, I'm not liquid. I have this house. I'm just going to sell my house. But to sell your house, there's expenses to sell your house, right? There's the real estate agent fees, closing costs, and stuff, such. And then you also have to actually put it on the market. And so if the market isn't ideal for you to sell at that given time, then you kind of, it's hard to plan your life based on a market that you have no control over.
Exactly, exactly. Yes. And the other thing is, I often have people say to me, "Well, maybe I'll just sell." Well, that's
Yes.
only half the equation. Maybe I'll just sell. What's the and what? And rent and
Right.
move into my daughter's basement. And what's the and part of that sentence? So, and let's say somebody is 90 years old. Well, I've got a lot of equity in my house. Maybe I'll just sell. But the older you get, the more burdensome moving can become. So I always encourage people, if selling is the right thing to do, call Abraham. You know, if selling is the right thing to do, it's just the right thing to do. But if your faith community is nearby and your
Right.
doctors are nearby, and, you know, do you really want to move to, you know, Idaho or whatever where housing
Right.
prices are cheap, or does that really make sense? Or does it make sense to stay where you are and have access to some of the equity?
Right.
You know, as I say, if somebody were 90, they're going to have a huge line of credit.
Hmm.
And that may well be for both support, community support,
Right.
and also for financial purposes. That may indeed be the best option.
Excellent. Yeah, what I really like about this idea is that, so you and I both, we live in Northern Virginia, and so Northern Virginia has housing costs, right?
Mhm.
High cost of living. So you really, and at least in my neighborhood, where our house is worth like $600,000, we don't really see that many elderly people in the neighborhood, and I think it's a byproduct of these individuals. They come, they move to Northern Virginia because it is a transient area. There's a lot of job opportunities. You make a lot of money while you're here, but I don't think that people do the best job of planning while they're here, and so
Uh-huh.
they're making some decisions that may cause them to have to move and kind of leave that support network. So it's very rare for us, even in my neighborhood, to see elderly people, right? And so like
Mhm.
I joke that we have like a grandparent shortage where we don't really have, we have that wisdom leaving the neighborhood. And it, for me, I'm 38 at the time that we're shooting this. And I want to be a grandparent in the neighborhood, right? Like I want to be a grandparent in the area, but that also, that's challenging to think about, because then I have to think about, well, will there be other people my age in this area?
Right.
Um,
Right.
and so I think it's like a quality of life issue, right? Like who you're going to be with. And so what I like about this idea, at least on my end, and this is why I want to interview you, is if I can get my friends and customers and clients to start thinking about this on the front end, then they could start to plan accordingly for the back end, right? Because it's really, if somebody comes to me at 65, they would have already had to have had some conversations before that moment. And so now they're kind of pressed against the clock, like
Yes.
it's time to perform, right? Whereas if we can get to somebody when they're 50, somebody when they're 45, like the earlier stages of their like the middle stages of their productive years, then we can plan better, if that makes sense.
Absolutely. So financial planners talk about the accumulation years, which is what you and I are in.
Right.
So we're still accumulating wealth, we're putting by savings, and then you have the years where you're drawing down. So you have the
Right.
drawdown years after the accumulation years. And it's what you don't want to see is somebody who's in an unsustainable drawdown. So they have their
Mm,
401k and their IRA and so forth, but they're burning through it faster than is sustainable. And they
right.
usually talk about the 4% rule, where you don't want to draw down more than 4%. But that's all well and good until one spouse either passes away and now the surviving spouse has 100% of the debt but
Mm,
50% of the income,
right.
or if one spouse contracts a truly besetting illness, and then your drawdown, it's like all bets are off, and it can be very difficult to save enough during the working years to provide income enough for the retirement years once somebody has really gotten ill. And I'll use this example of somebody, a client, in the very near past, but husband and wife are both ill. One has
Right.
memory issues, and then the other has a very slow form of MS. But both of these are super costly. So the spouse with MS was taking care of the other spouse who is in the early stages of Alzheimer's, but now they both need care, and their care is costing about $22,000 a month.
Oh my goodness.
So, how do you put by enough in your working years to provide for $22,000 a month in home health care? And, well, in their case, they were in a very high value home. The house was completely paid off. So the amount of equity they qualify for is huge. I mean, they have about, I think when all was said and done, they had about a $450,000 line of credit.
Right.
And they'll draw that down, and they have other monies. They do still have other money. So it's not as though they had run out, but they could see that the drawdown was too rapid for them to be able to sustain. So this is going to be another infusion of liquidity for them. And by the
Gotcha.
time they use up all of that, the husband probably will need to transition into a residential facility anyway. But at this point, he just is adamant he wants to stay home. The wife wants him home. So this is the perfect example. But that's somebody who is they're farther along in age. The person who's
Right.
doing advanced planning, which is what you were addressing, that's the person who will originate, and they'll just not touch it for years.
Right.
Let it
Right.
accumulate that growth, and it'll just be part of the planning process.
Exactly. Let me ask you this. So in the scenario you just gave with the couple that both have medical issues totaling up to $22,000, what happens when those individuals, because I used to work in a long-term care industry in like when I was 19, 20 years old. And so I saw, like a husband will come into the facility and then like later on the wife will come in, right? Because they're at different stages of health. What happens to the house when both of them move out? Is that the time when that triggers the clause because it's no longer their primary residence, right? Like they live in a
Great
facility.
question. Yes. So when neither occupies the property, then typically it's the adult kids who will put the home on the market, sell it. Whatever has actually been borrowed plus the interest on that gets repaid.
Right.
It's a loan, so the loan gets repaid. The homeowner, the heirs, or the estate get the rest of the equity, including any appreciated value of the home.
Gotcha.
So we're assuming in this case, we're just going to arbitrarily put them in Northern Virginia. Of course, we're having about 7.5% appreciation, home appreciation right now. So let's say they've had this reverse mortgage for 4 years. They used up everything they had in the reverse mortgage, just for argument's sake. So how much is due? Well, however much they borrowed, plus the interest on that. What belongs to the homeowner, the heirs, or the estate? Everything else, including however much the home's appreciated by. And so they need to start moving on it. They being the adult kids need to start moving on what's going to happen with the home. They could pay back the mortgage if they want and keep the home. But in most cases, the kids put the house on the market, they get it sold, and sometimes the house sells, especially Abraham in your area and mine, the home sells before it's even registered with the FHA with the servicer that the home is empty.
Right.
They'll get snapped up in 3 hours. But yes. So the family does need to reach out to the servicer and say, Mom and Dad don't live in the home anymore. And then the servicer will walk them through their options. Do you want to pay off the mortgage, keep the home? Do you want to sell the home?
Right.
Do you want to refinance the debt into your own name? What do you want to do with the property? And then you take steps appropriately. And typically, as I say, most families just put a sign in the front yard, home for sale, get snapped up, end of story.
Excellent. So this is another point I wanted to talk about. When in my research, I've noticed some detractors who are talking about the program talk about how the heirs don't get the property or the heirs miss out on opportunity of keeping the family home. And I think it's only like less than 2% of houses that are passed on to the next generation are kept. Like usually the next generation just sells the property anyway. So what's cool about this, or not, what's interesting about this is with my clients who are over the age of 60, they're usually pressed, or they have a hard time getting rid of the stuff that they thought that their kids would take. Right. They thought the kids would take that sofa, right? That's from the 60s.
The China set.
Yes. The China set, right? But a lot of kids these days, or a lot of people in our generation, they don't entertain like that, right? And they don't consume in that manner. So I think that people have this idea of what happens when they retire, or they have this idea of what happens in their later stages, and their kids have their own lives. So we can't really use that model for our golden years or our later years and kind of plan our life with our kids in mind, because our kids, as you know, you have a kid, you have kids, we have no idea what they're going to do really, right?
Right. And I'll tell you one thing I know they're not going to do. They're not going to stand at the ironing board ironing the linen, right? Which is still a thing that I enjoy. I love the smell of pressed linen. So my kids, I look at all these linen tablecloths that were handed down to me from my mother and my grandmother. I'm not so sure my kids are going to want to stand
right
there. So that's a funny example. But you are exactly right. So about 2% of adult kids keep their parents home.
Right.
And here, so I'm going to answer the question you did ask and then answer a question you didn't ask. So I do also sometimes hear kids say, oh, my mom had a reverse mortgage and I didn't know about it. With the implication being, either all the equity was supposed to come to me, or the
Right.
house was supposed to, supposed to, in air quotes here. What does that even mean, supposed to? But
Right.
the other thing that I think a lot of times doesn't dawn on the adult children of aging parents is the following. Your mother had a home equity line of credit of $400,000. She used all of that. You know what that means? You didn't have to bankroll
Right.
mom.
That's true.
Mom needed that money. And what would have happened if mom didn't have that $400,000? She would have had to rely upon you. You would have been either prematurely drawing down your 401k to bankroll mom,
Right.
or you wouldn't have been saving in your own 401k for your own retirement if you had been bankrolling mom. So the biggest blessing mom could possibly have given you is you're not having to bankroll your own mother.
Exactly.
And a lot of times the light bulb will go on when people realize, you know what, my mom never asked me for money. She never
Right.
asked me for money. She didn't live high on the hog. It's not like she was driving some, $100,000 Beamer. My mom
Right.
was driving the car she had bought when Jimmy Carter was in the White House. She never came to me for money, and I never stopped to think how she was making do on
Right.
$1,100 of Social Security. How was she doing it? She was using the equity she had built up over
Right.
time. And I actually wrote an article once that was called The Biggest Blessing. And that biggest blessing was when aging parents are able to be self-pay to the end of life, both between what they've put by and, if they have that reverse mortgage. So the biggest blessing is the kids haven't had to come to your generation or to my generation
Right.
to help bankroll them through those later years.
I got to tell you, this is the part of the conversation that's missing when I see the detractors online. When I see them talk about the
It
negative
is.
points about the conversation, because like I said, I guess I'm fortunate that I worked in long-term care facilities in my early years. So I saw the kids not come and see their parents. I saw
Yes.
the parents trying to reach out to family members and nobody responding. I saw lonely old people who thought that these people in their lives who they took care of, they raised, were going to take care of them, and they did nothing. And now we have
Uh,
people talking about the fact that I don't get the house or I don't get the equity. This
right.
this individual has to live. They have to live in a respectful life, right? We I don't think we hear enough people talking about dying with dignity and
Age or aging with dignity. Yes, yes. And
yes,
that same person who does not have kids coming to visit may have prospered in their own home where they knew the neighbors and the
right,
neighbors were dropping by, or
exactly.
they could look out the window and see kids riding their bicycles up and down the street or whatever. So that same person, now there absolutely, I don't by any stretch mean to be a detractor for care facilities. They
Right.
absolutely play a role. But many people, as a matter of fact, I like to say I've yet to meet the homeowner who says my goal in life is to get old and sick and die in a nursing home.
Right.
That's not most people's go-to plan. Most people
No.
would rather age in place. For some people, it comes to the point where they simply can't manage at home, or it's not safe for either them or their spouse who's trying to care for them. So a care
Exactly.
facility plays a role. But many of those people, if given their druthers, say, "Oh, I would have loved to have stayed at home, but," and a lot of times that
Right.
but is the property taxes were too high, or I was running out of money, or whatever. And if they had known about a reverse mortgage, it may well have made the difference, and they may have been able to age with dignity in their own home.
Exactly, exactly. Yeah, that's I would say that that's important to me. That's why I like this conversation or I like this product because I'm really big on community. I'm from the South, I'm from New Orleans, and so I'm used to my grandmother lived right around the corner from me. My great aunt who just died at the age of like 94, 95, she lived three doors down from me. My great uncle lived like 3 blocks down from me. And so I'm used to having elders in the community
Yes.
and living in Northern Virginia, my kid, like we have, I run a dad's group. And so even in my dad's group, we have dads talking about like things that they believe are pressing issues. But if we had elders in our community, they would tell you that that's not an issue. Life goes on.
Right.
And
Don't sweat the big,
don't,
small stuff.
yeah,
Yeah.
don't sweat the smart stuff. And so I guess I'm trying to like the reason why we're doing this interview is I'm trying to kind of create the environment that I would like to see, to create the community I would like to see. And I know I can't approach this when I'm 60 and I'm, a lot of my clients, because I'm growing with my client base. So I'm trying to get ahead of this and start to help people plan now. Because if you think about it, having you on the show and introducing you to my clientele, we haven't even talked about the reverse purchase product, which we'll probably have to do another session because this is already getting long. But having you on the show kind of reduces the number of transactions that I'll most likely do, because it promotes people staying in their properties. But I think the quality of life of the individual is much more important than the transactions I'll do. Like, I want to see
And
people
that's, yes.
have.
So many of my clients come to me through realtors, quite
Gotcha.
frankly, because they'll talk to Mrs. Smith. Mrs. Smith will say, I really don't want to move, but
Gotcha.
can't afford the taxes or whatever. And then that realtor picks up the phone and calls me. But I will say it doesn't reduce them. It just delays them, because
Right.
you send over a client, I put in my phone, Mrs. Smith. And then if Mrs. Smith transitions into other housing, then the first and needs to sell the home, the person I pick up is the person who's in my phone, or the person I call is the person in my phone, and that would be you. So
Gotcha.
reach out to the fan. Yes,
Gotcha.
yeah. So, and any of my realtors will testify that that is true. I
Excellent.
call them as soon as I hear from the family that they
Excellent.
need a realtor. Yes.
So I know I want to get to the reverse mortgage for purchase product. Is it okay if we schedule another time to talk about that?
Oh, of course. Of
Okay.
course. Yes,
Okay.
yes, yes. We
Yes.
don't want to turn this into a marathon.
Right. Right. But let's talk about let's end this segment on like a couple of frequently asked questions that I noticed in my research. What happens if an individual has bad credit? Can they still qualify for this product?
They can. They absolutely can. And there are a couple of cures. If somebody has been chronically late on property taxes, hasn't kept the home insured, has had big issues with credit card debt, then we can do something that's called a life expectancy set aside, which is a big escrow. So we set aside enough money to pay their property taxes and their homeowners insurance for the rest of their projected life. We hold it aside, pay that on their behalf. And then the balance, whatever's so let's say in this case they qualified for 60%, and we have to set aside, let's say, $50,000 to cover their property taxes and homeowners insurance. That comes right off of the top of what they qualified for. So they're going to have less available in their line of credit, but they never again have to worry about, or presumably, I mean, if they live to be really, really old and we use up what we've held aside, they might have to step in. But as far as the credit score goes, it really depends on the nature of the bad credit. In many cases, bad credit has been caused by the loss of a spouse, the
Okay.
loss of a job, or by medical defaults, or a medical issue has caused somebody to be late in paying their credit cards. So is
Right.
what we do is we write letters of explanation. We have to back it up. We have to show, yes, you were indeed in the hospital during that time. And then in most cases, we can just work around that bad credit. It does have to make sense. Your storyline has to match up with the credit defaults. But
Right.
yes, bad credit, I would say 99.9% of the time can be worked around.
Gotcha. Okay. Excellent. And why do you think that the reverse mortgage have such a bad reputation?
It used to be a bad product.
It used to be a bad
Oh,
product.
I love to say that reverse mortgages worked very hard to get a bad reputation. And this dates back to really before they were an FHA product. So back in the 60s, these were not an FHA product. They weren't regulated. It was just a bad product. In many cases, it was actually a predatory product. And that corporate memory has just kind of washed forward. But then once it did become an FHA product, there were a couple of issues that, in my opinion, were true problems with it. Namely, the loan to value was too high. So back when I first started, depending on your age, you could walk out the door with a huge lump sum. And then, of course, 2008 and 9 hit, and homes went down in value. And so it didn't impact the family. The family didn't have to write a check for the shortfall, but it did overtax the FHA general fund, where the
Right.
insurance had to pay out to cover those underwater mortgages. So it was not well thought through. The loan to value wasn't updated with expanding life expectancy. So the biggest problem is the much, much older 40 or 50-year-old reputation that has
Right.
just dogged its feet. But then there were some tweaking that they definitely needed to make on the part of FHA to bring it up to speed with current life expectancies.
Gotcha.
Great,
Gotcha.
great question.
What is important about your 151st birthday?
So the loan becomes due and payable when you turn 151. So FHA has rolled that date out there so far that nobody is going to hit it in all likelihood. But there's no back end to this loan. You can continue to live in the home until you pass away, or until you need to sell, or transition into other housing. But at 151, then the loan officially becomes due and payable.
Gotcha. Now, how could you lose your home? I know this came up in some of my research.
Yep.
Somebody gets a reverse mortgage. Talk to me about some of the ways people lose their home with a reverse mortgage.
So I love to put this into context. Let's say you had a paid off home. Can you lose your home?
Yes.
How do you lose your home if you have a paid off home?
You don't pay the taxes. You don't
You
pay the
don't
HOA
pay the
fees.
taxes or the HOA. Yeah, now HOA will generally not force you out of your home. They won't
Right.
do a sale. They'll just put a huge old judgment against your property, against the title.
Right.
You don't pay your taxes, scary people come knocking. And it's
Right.
the exact same way with a reverse mortgage. You've got to pay your property taxes, or if you're property tax exempt, in almost all jurisdictions, there's a property tax waiver for the elderly and disabled. So if somebody's income is starting to drop, they need to talk to the county or give me a call, and I'll guide them on how to apply for the property tax waiver. But you must keep your home insured. Got to keep the taxes paid if applicable, and then you have to pay your HOA or your condo dues depending on where you live.
Gotcha.
And then, as you alluded to earlier, you've got to live in the home.
Right.
You can't just move out and use that as a rental property.
Excellent. Excellent. Um, I think we've come to the end of this particular session. What question I didn't ask you that I should have asked you so far about because I think that today's session was more about the reverse mortgage for refinance purposes.
Yes, exactly.
So what questions do you think that I missed that you think that would bring value to somebody watching this video?
Well, one thing I always encourage people to do is let's do a conference call with any caring person in your family. So adult children are my favorite people to incorporate in the conversation.
Okay.
Loving, caring neighbor. So I very much encourage people to make this a family decision for long-term financial planning. If you have a financial planner in your life, let's get him or her on the phone, an attorney. So that would be the biggest, if I could make any tweak in somebody's life, I would say, please, 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 let's draw in your circle of support so that everybody's on the same page. Everybody has a chance to ask questions at the same time, because I think we age better when we have that community.
Right. Excellent. So, Laurie, what is the best way for people to get in touch with you?
They can always pick up the phone and just call me. And my number is easily found online. But do you want me to say my phone number? Is that helpful?
Yes, you can say yes. Yes,
Okay,
ma'am.
so my phone number is 703-477-1183. And then I can be reached online at Laurie@middleburgreverse.com.
Well, Laurie, thanks so much for joining me. I'll have you back on the show to talk about the reverse mortgage for purchase product. Also, I want to have you back on to talk about property taxes exemption process too. I know that would be a valuable
Yes.
conversation as well.
Yes. Super. Well, great being with you, Abraham.
Thanks so much. Take care.
You too. Bye-bye.
Bye.